Carson, this game, I'm getting a kick out of it because when it started, we were in a market that was net long. And now you're looking at a lot of people starting to win more deeply off their shorts. For example, Bill Ackman, short the financials. That looked smart today. Stan Druckenmiller, short consumer discretionary. What about you? When you think about the ability to go short in this market, how deeply do you dive in?
Well, so for us, I mean, we do, all of our shorts are basically the subject of activist short reporting at some point. So the name that we're short for the contest anyway, and we're not actually short it in real life anymore, but is Grifols. And that was the subject of an activist short report by Gotham City Research. And that's a company based in Spain. And it's actually pretty interesting because, you know, at this moment, obviously, there's a lot of political turmoil, and you go to Vice President J.D. Vance's dressing down of NATO ministers a few weeks ago over free speech in the EU. It's funny because with Grifols, the national regulator in Spain actually investigated the allegations by Gotham City Research and has largely corroborated them. Grifols expects to pay, though, a fine of no more than €1 million. However, the principals behind Gotham City Research are presently under criminal investigation for that report in Spain and could do up to 6 years prison time. So Grifols really does have this political overtone as well that makes it interesting.
Well, I want to talk about a stock that you don't recommend going short. I'm talking about Tesla. You spoke to Bloomberg TV about a month ago about Elon Musk and Tesla. Let's take a quick listen.
It's one thing to ask whether you bet on Elon Musk, but I would not bet against him. I wonder if I suspect he has switched views on a macro level, but especially with how he thinks about Tesla. That would be a little bit embarrassing for him to say publicly. So yeah, maybe just banging the table about, AI and robo-taxis is how he tries to cover up that sentiment shift internally.
So, Carson, that was on February 18th. The stock is down mightily since then, down about 38% year to date. I know that Tesla has broken the hearts of many folks who have tried to go short it, but is that still the advice? Don't bet against Elon Musk?
Well, I'd say more aptly, Tesla has broken the backs of many people who've been short it. But look, I still maintain that it's really hard to bet against Elon Musk. Of course, that was awesome timing when I said that because it's been about the best short you could find on the planet since the moment at which I said that. But, I think that's more due to market factors and technicals and political uncertainty. Look, I've long been critical, and I agree with many of the shorts over the years that he has not been honest. I've called him publicly a liar. But also nobody has played the public company game better than Elon Musk. Now, is he doing irreparable damage to the Tesla brand with his political involvement? I mean, maybe, but again, this guy for years and years and years has done nothing but pull rabbits out of the hat. Just when you thought like he was about to go over the edge of the cliff, he comes back. So it's just a very difficult person against whom to bet. So, yeah, we're happy looking elsewhere for shorts.
What do you think about the broader Mag 7, Carson? Back in October, you said close your eyes and buy in terms of the big U.S. stocks. For a while, that was a great bet, right? Until I guess the market hit its high, right, in last month. Now we've seen the Magnificent Seven come down. I think all of them are losers year to date, with the exception of Meta. Is it time to short these stocks, or do you think they're going to continue to have, I guess, a little bit of resilience even after the pause that refreshes maybe that we've just seen?
So the larger context of what I was saying there was I was talking about how in the U.S., the markets are so warped by passive investing and fundamentals matter, less and less every day. So the Mag 7 will continue to attract, because the S&P 500 index, it's really an active index, right? They always cull the herd and drop the weakest. And then the companies that are experiencing the most market cap appreciation get greater weighting. So it's also a momentum index. So momentum has sold off. But when you look at why has momentum been such a strong way to play the markets for, since really the GFC, it has to do with monetary policy, and what's been for the vast majority of time, extreme stimulus. And it's also been significantly attributable to the shift from active investing to passive investing. So I don't see us going in reverse away from passive. So yeah, like 22, you had a reversal when conditions tightened and rates went up. And we're seeing political uncertainty weighing on the markets right now. But yes, structurally, the top names in the S&P 500 are going to continue to attract flows. And most of those flows come from 401k purchasing. So if you see a situation in which unemployment climbs significantly and 401k net flows become net negative, then you have to watch out. Then all those stocks go into reverse hard, and it's hard to see where the bottom would be. But at this point in time, I don't see that.
Carson, one thing that I've been watching very closely is the turn in sentiment around financial stocks. This was a hot trade at the end of last year. You made some big calls. The one against BXMT in regard to the dividend turned out to play out. Now I'm wondering how you're looking across the financials universe. Are you looking for new shorts in banks, in real estate? Where's the pain?
Well, look, we're generally not thematic. So we're only thematic when we look in the rearview mirror. So we were really early on a lot of shorting the ESG type names. So right now we're not looking in any specific sectors or even industries. In terms of commercial real estate, I don't know how much juice there is to be squeezed there, because now there is this uncertainty around rate cuts. If rates get cut enough, at some point, the CRE starts to look less bad than it had been looking. So at this point, I don't really want to I've never wanted to try to make a rates bet, at least on the future direction of rates. So I think if you're considering CRE type shorts, you're starting to get into that land right now. So as you said, our thesis on BXMT played out. We're happy about that, but I think there's too much uncertainty going forward for us anyway.
Carson, what about elsewhere in the world of financials? One thing that there's a lot of bell ringing about is the difference between public and private marks. Yet you are starting to see more private capital type vehicles enter the public markets. Private capital entering public markets. Are you looking at BDCs or other types of vehicles that might have private holdings that might not be reflecting those underlying marks?
Well, that's interesting, because I think it was maybe around 2015, 2016, BDCs were a pretty hot area for short sellers, and also prior to the financial crisis. If you remember, David Einhorn, Greenlight, famously shorted one of the big Allied Capital and wrote a book on that. So yeah, BDCs in the past have been very aggressive with their marks. From our perspective, the issue is there enough liquidity in the BDC? And so a lot of the air had come out of them at some point. It's not an area that we've looked at recently, but yeah, I think once you get a lot of capital flowing into that space, you will certainly have players who are going to be a lot more aggressive. And really, anybody who gets to make up their marks and gets compensated based on that has a built-in incentive to be really aggressive with the marks. And we've never believed, whether it's a VC fund, a private equity fund, a BDC, we've never believed that across the board, these marks are genuine marks, are really, good faith expressions of the values of the underlying assets. So yeah, that could be interesting.
Yeah, well, there is plenty of capital flowing in. We know that, especially from retail now, which is a new buyer base. I do want to go around the world, and I want to talk a little bit about China. Of course, your views on China are well known, but you've seen this chorus of sell-side analysts come out and talk about China in a bullish light. You think about Citi just this week, downgrading U.S. stocks, saying to basically upgrade and buy China. I'm just wondering what you make of that in this cycle.
Well, everybody's got to sell a growth narrative, right? So, China's been this, there's so much muscle memory, for the past couple decades of selling the China growth narrative that I'm not surprised everybody's going back to that, and they're willing to forget all of the political risk that Xi Jinping presents and how he's basically zeroed out, several classes of public company shares in the past, such as for-profit education, or close to zeroed it out. Look, it's, China's a trade, it's not an investment. You date China, you don't marry China. Like, I get it if from a tactical perspective you want to allocate money there, fine. But that's the kind of place you wake up one morning and, they invaded Taiwan and maybe the U.S. is going to war over that. And, basically you don't want to be long anything China related at that point in time. So I think everybody who's rushing in headlong needs to be aware of those risks and needs to have eyes wide open. China is not marriage material.
Carson, you married Vietnam. You're, I guess, considering an engagement with India. I want to talk about your longs. You mentioned the possibility of war, which seems more likely now than it has in decades. We're seeing a war in the Eastern Theater of Europe. And Rheinmetall came out this morning and said they see defense sales surging 40% on the European spending boom that's expected. Is that, you think, one of the most important long threads for investors to pay attention to?
European defense spending?
Well, in general, war, defense spending around the world.
Absolutely. Well, look, from a defense spending perspective, that's, that one's above my pay grade. But the geopolitical risks and the risks of war, absolutely. I don't know that Russia is in a position to make further moves in Europe in the next few years. But, what we're doing with Ukraine and basically rewarding Russia, I think that leaves a lot of powder in that powder keg. Obviously, the situation with Taiwan, I don't know that we're doing anything right now to dissuade Chinese aggression against Taiwan. Iran has been, I think, beaten back nicely by the Israelis recently, but they're probably not going to go quietly into that good night. So, yeah, this is a world that has a lot of risks of real, of expansion of kinetic war. So, and valuations just generally don't seem to recognize that because risk is massively underpriced, as it has been since the GFC.